Most people approach the choice between a Roth and a traditional retirement account with a simple question. They ask, should I pay taxes now or pay taxes later? This frames the decision as a straightforward guess about future tax rates. It feels like a coin flip. That is a common way to think about it, but it is not the part that actually matters most. This perspective is incomplete. It misses the deeper, more structural impact this single choice has on your financial life. An impact that changes significantly depending on where you are in your own journey. The real decision is not just about a simple tax calculation. It is about control. It is about flexibility. It is about the very ceiling of your potential wealth. If you're over 50, a simple mistake in this decision could cost you 5 figures in retirement taxes. If you're under 30, this choice determines your wealth ceiling decades from now. This isn't just a basic account setup, it's the biggest tax decision of your working life. We are comparing Roth versus traditional accounts, and by the end of this video, I will give you the one simple rule to know which one is absolutely right for your situation today. To make the right choice, you first need to understand the system you are working in. The tax system is not some unknowable force. It is a set of rules, like the rules of a game. Retirement accounts are special tools designed to help you play that game well. Think of the government as a silent partner in your earnings. Retirement accounts create a protected space for your money, shielding it from that partner for a period of time. This protection is what allows your savings to grow more powerfully over the long term. There are 2 primary ways these accounts offer protection. The first way is what we call pre-tax. This is the foundation of a traditional account. When you contribute money to a traditional 401k or IRA, that money is taken out of your paycheck before your income tax is calculated. This lowers your taxable income for the year, so you get an immediate tax break. The government agrees not to take its share now. It will wait until you are retired and start taking the money out. At that point, every dollar you withdraw is taxed as income. The second way is what we call post-tax or after tax. This is how a Roth account works. With a Roth, you contribute money that has already been taxed. You get no upfront tax deduction. Your taxable income for the year remains the same. However, the deal you make with the government is different. In exchange for paying your taxes today, the government agrees to a powerful promise. All of the future growth in that account and all of your withdrawals in retirement will be completely tax-free. Do you pay from the smaller seed you plant today, or do you pay from the much larger harvest you will collect in the future? This distinction is the starting point for understanding the true power dynamic at play. The real engine inside any retirement account is compounding. This is the process where your investment earnings begin to generate their own earnings. It is a slow process at first, but over decades it becomes an unstoppable force. The tax treatment of your account directly affects how this force works for you. In a standard taxable brokerage account, you might pay taxes on dividends and capital gains each year. This is like a small leak in your financial engine. Retirement accounts plug that leak. Inside a Roth account, your investments can grow year after year without any tax bill. Inside a traditional account, your investments can grow year after year without any tax bill. This uninterrupted growth is called tax-deferred growth. This allows the snowball of your wealth to get much, much larger than it otherwise could. With a traditional account, you are letting the entire snowball grow as large as possible, but you know that the government will claim a piece of it when you finally start using it. With a Roth account, your initial contribution is smaller because taxes have already been taken out. However, that smaller seed and all of its future growth are yours to keep, completely free of future taxes. The question is whether you want the tax bill to be calculated on the small seed you plant at the beginning or on the giant tree it grows into decades later. One of the most important rules for many people is the employer match. This is essentially free money. It is a 100% return on your investment instantly. Regardless of your choice between Roth and traditional, you should always contribute enough to get the full employer match. Not doing so is like refusing a pay raise. By default, nearly all employer matches are made on a pre-tax basis. This means that even if you are contributing to a Roth 401k, the money your employer adds will go into a separate traditional pre-tax bucket within your account. Another key rule is about when you must start taking money out. The government does not let you keep money in a traditional account forever. This is enforced through required minimum distributions, or RMDs. Starting in your 70s, you are forced to withdraw a certain percentage of your traditional account balance each year, and you must pay income tax on that withdrawal. This can be a problem if it pushes you into a higher tax bracket in retirement, especially if you do not need the money. Roth accounts have a significant advantage here because the taxes have already been paid. There are no required minimum distributions for the original owner of a Roth IRA. You are never forced to take money out. This gives you tremendous control and flexibility in managing your retirement income and your tax bill. We have covered the system, the mechanics of growth, and how the ideal choice changes with your stage of life. But theory can only take you so far. To make a confident decision, you need to see how these concepts work in the real world. Now here's where this becomes practical. Before we go further, this next part matters. I say that because it is very easy to listen to financial advice, nod along, and understand the concepts intellectually, but then fail to take the final step of applying it to your own life. This is the distinction that resilient individuals and businesses understand. They do not just collect information, they build systems for decision making. So pay close attention to the steps we are about to take. The goal here is not for you to memorize a complex formula. It is for you to internalize a way of thinking. To make this practical, let's create a detailed real-world scenario. We will focus on the profile of a young professional. Let's call her Sarah. Sarah is 28 years old. She is single. Her starting salary is $70,000 per year. Her company offers a 401k plan with a generous employer match, 100% of her contributions up to 5% of her salary. The 401k allows contributions to a traditional 401k. It also allows contributions to a Roth 401k. The first step for Sarah is to analyze her current tax situation. Her $70,000 income places her in the 22% federal marginal tax bracket. Now, she must compare this current rate to her likely future rate. With a long career ahead, it is highly probable that her income will rise, pushing her into higher tax brackets. Therefore, the core question becomes, is it better to pay a 22% tax now or a potentially higher rate later? Paying taxes at 22% today seems like a bargain. Based on the evaluation, the logic strongly points toward the Roth 401k. She is prepaying her tax bill at a likely discount to future rates. The final step is to address the employer match. Even though Sarah is contributing to her Roth 401k, the $3,500 match from her company will be deposited into a traditional pre-tax bucket. This is a crucial detail. She is automatically building two pools of money. This hybrid structure is actually an excellent outcome, giving her flexibility and control in retirement. We have moved through the system, the strategy, and the practical application. After analysis, the complexity distills to one guiding principle. The rule I promised: pay taxes at the lowest rate available to you. Compare your certain marginal tax rate today to your probable tax rate in retirement. If today's rate is lower than retirement's, choose Roth. Pay taxes now. If today's rate is higher than retirement's, choose traditional. Defer taxes. It's a comparison of your personal tax rates across time. Focus on the variable you know best, your financial trajectory. The decision between a Roth and a traditional account is a cornerstone of your financial structure, but it is just one part of a much larger system. A resilient financial plan is not built on a single choice, but on a series of well-reasoned, interconnected decisions that work together. It is about laying a solid foundation, piece by piece, so that what you build is strong enough to last a lifetime. If you're building something meant to last, the next video on this channel builds directly on this idea.